Hello everyone. Let's talk about something most people ignore during market downturns, and that is how to protect your hard-earned money during a recession. Most of the time when the market starts crashing, everyone rushes to talk about which stocks to buy. But that's not the first step. If you don't know how to protect your capital, you won't even have money left to invest in opportunities when they arise. So in this video, I'm going to break down the 5 most important things you need to do to protect your wealth during a market downturn and make sure you come out stronger on the other side. Stick around because this is exactly what I'm doing in my $200,000 portfolio to navigate through this tough market. I previously made a video on January 7th, 2025 explaining why I'm holding a large cash position and why I believe 2025 will be a challenging year for the stock market. If you haven't seen it yet, I highly recommend checking it out. I'll link it in the description below. Alright, now let's get to the actual topic. The first important thing everyone should do is avoid using margins because it's a trap. One of the biggest risks in this market is margin debt, and I have a crazy chart to show you, and that's the FINRA margin debt chart. Right now, retail investors' margin debt is at a 5-year high, and that is very bad for the market because when stocks start dropping, those who borrowed money to invest get into big trouble. Let me explain how margin works. When you buy stocks using borrowed money, your broker will force you to either sell stocks or deposit more cash if your portfolio value drops too much. This is called a margin call, and when people start selling just to meet those calls, the market drops even more. And guess what? Right now, people are paying an average of 12% interest on margin loans. That's insane. Imagine taking out a loan at 12% interest only to see your stocks go down. You are paying huge interest and losing money at the same time. So my number one advice for 2025 and 2026 is please do not use margin. The market is going to get very bumpy and using borrowed money will only put you in a worse position. I personally never use margin and I highly recommend you avoid it too. The second most important thing you need to do is only invest in high quality stocks and ETFs. When the market corrects, everything seems like a good deal. But here's the problem. Not every stock recovers when the market bounces back, and I personally learned this the hard way. During the COVID market boom, I bought stocks like Nikola, Fubo TV, Lemonade, and Teladoc. At that time, they looked like great investments, but then the reality hit. They crashed 90% and never recovered. That experience taught me a valuable lesson. Not all stocks bounce back, and you must focus on quality over hype. That's one of the biggest reasons I started this channel, to share my experiences so you can avoid making the same mistakes. Here's what I'm personally buying in my $200,000 portfolio. I have stocks like Amazon, Google, and Microsoft. These companies are leaders in their industries and will thrive in the long run. And I have ETFs like SCHG and SCHD. These are ETFs with low expense ratios and solid dividends. ETFs are less volatile because they contain 100 plus companies, which make them safer than betting on individual stocks. When the market drops, I'll be adding to these positions at key support levels I have been mentioning in my videos. If you are building a long-term portfolio, stick to quality. This will protect you from stocks that never recover. Third most important thing is to hold cash, which gives you a huge advantage. Most people make the mistake of going all in too early when the market starts dropping. But here's the truth. Corrections and recessions can last longer than you think. By holding cash, you give yourself the ability to buy more when stocks get even cheaper. And you know who else does this? Warren Buffett. Right now, Buffett's Berkshire Hathaway is sitting on a massive $334 billion in cash, waiting for opportunities. He knows that the best time to invest is when markets are in panic mode. And even for myself, I have $144,000 cash sitting in my Robinhood account, waiting to be deployed at the right opportunities. Think about it. When stocks crash, that's the time to buy the best companies at a discount. But if you don't have cash, you miss out. That's why I always recommend keeping a cash buffer. Let's get to the fourth important thing, which is to invest in recession-resistant sectors. During a recession, not all sectors are hit equally. Some sectors always do well because people need their products no matter what. Here are the best recession-proof sectors. The first one is healthcare, which contains Johnson & Johnson and United Healthcare. People still need medicine and treatments. And the second recession-proof sector is consumer staple, and we have stocks like Procter and Gamble, Coca-Cola, and Pepsi. People keep buying essentials like food, beverages, and household products. And the third recession-proof sector is utilities. For example, we have stocks like NEE and DUK. Everyone still pays for electricity and water. And finally, we have gold and silver. These are traditional safe haven assets that can hold value when stocks fall. And personally, my own portfolio already has some recession-proof stocks, including Johnson & Johnson, which is a strong healthcare company, Coca-Cola, because people still drink Coke no matter the economy, and I have McDonald's and Chipotle. The fast food tends to hold up well during market downturns. And finally, we have Target and BJ's. And I think people continue to buy groceries and household essentials. Having some exposure to these defensive stocks help protect your portfolio from extreme volatility. And the fifth and last important thing is to think long term and avoid panic selling. This is the most important point of all. Recessions are temporary and market always recovers. Look at the history. Whether it was the 2008 financial crisis, the COVID crash, or any other major downturns, markets always come back stronger. The worst thing you can do is panic sell good stocks. If you have invested in strong companies, ride it out. Here's a simple way to think about it. If your investment time horizon is 5+ years, short-term crashes shouldn't matter. In fact, buying during a recession can give you the highest returns when the market recovers. That's why I'll be adding to my high-quality stocks and ETFs whenever we hit key support levels. And here's a bonus tip. Invest in ETFs or mutual funds during market corrections. If you don't want to pick individual stocks, a great way to invest during a recession is through ETFs and mutual funds. ETFs diversify your investments automatically and give you exposure to multiple companies. When the market recovers, these funds tend to deliver huge returns. Some of the best ETFs to focus on are large cap growth stocks like SCHG, dividend paying companies like SCHD, broad market index funds like S&P 500 funds. So if you don't want the stress of stock picking, consider buying mutual funds or ETFs during market downturns. Here are my final thoughts. Protecting your wealth during a recession is just as important as investing in the right stocks. If you follow these steps, you'll not only protect your money, but you'll also set yourself up for massive gains when the market bounces back. This is exactly what I'm doing in my $200,000 portfolio. And I'll keep you updated as I make new moves. Drop a comment below and let me know how you are preparing for a potential recession. Are you holding cash, buying ETFs, or avoiding margins? Let's discuss. And if you found this video helpful, don't forget to hit that like button and subscribe for more investing insights. Thanks for watching, and I'll see you in the next video.